Let's go, folks. Good morning, one and all. Welcome to the street today, here from Post 35 on the floor of the New York Stock Exchange. You may notice something new. It's a new name of the show. That's why it took me a second to get the hang of it. You may notice a few things different this morning. We've officially rebranded our show from the Market Open to The Street Today, which I more or less nailed the first time I had to say live. You can also catch us every weekday morning right here live at 10:30 a.m. As for today, it is Tuesday, the 17th of January. I'm your host, JD Durkin. We are about an hour and 1 minute specifically into the trading session. Stocks are in mixed territory. The Dow's been down, the S&P's been up. This to kick off the shortened week as investors digest the latest round of bank earnings and look ahead, of course, to a big week of earnings still to come. Taking a look for what is on tap for this Tuesday morning's broadcast, we talk earnings as a whole bunch of S&P 500 companies gear up to report this week. Plus, we talked the latest out of China after that region revealed its weakest year of growth in over 5 decades. Plus, we will be previewing what to expect from Elon Musk as the billionaire CEO set to face trial over 2018 tweets involving Tesla. Remember the whole funding secured 420 thing? Now he's got to answer for why. It's been out there in the ethos for years. Everyone's been wondering. Well, today you got to face the music. For more on those stories and so much more, we now welcome in our chief markets correspondent to help us kick off this shortened trading week, Mr. Martin Baccardax. Martin, good morning to you here, sir. Hope you had a nice long holiday weekend. Wall Street coming off of back-to-back winning week to kick off 2023. Many are wondering here, Martin, if that momentum can continue. I wonder from where you sit, is the focus on earnings first and foremost through the rest of January until the next FOMC meeting in early February? What's right on the horizon?
Yeah, I think, to be honest, JD, that's probably the near-term focus for, I wouldn't say completely, but for the most part, the market has put the Fed concerns to one side. We're looking at the anticipated rate hike on February 1st of 25 basis points. I think that's a done deal, and we are expecting the Fed to hold at around 4.75% for its terminal Fed funds rate when we get to the early spring. Now, those bets could change, but for the most part, I think that's the anticipation. And as a result, the Fed tightening concern is pushed to one side, and the earnings focus is now front and center. We've had, I would say, a reasonably solid start to the earnings season, but by no means can we describe it as spectacular. I think we've had, prior to this morning, about 29 companies have reported, and essentially the percentage of companies that have beat street estimates was around 75%. Now that matches the average over the past 4 quarters. Now it's a little bit above the long-term average, but it's about steady to the near-term average. So we're right in line. Again, nothing spectacular, but for the most part, maybe a little bit better than anticipated. I know the banks, again, apart from Goldman Sachs, and we'll talk about that later, were stronger than expected. But we're still looking at that sort of annual decline for earnings of around 2.2%. Strip away the energy, and that number balloons to about 6.6%. If we could top those expectations and drive tech earnings into February, then there's a chance for this rally, I think, to carry on.
So one more time, if we can, hit the FOMC before we dig into Goldman specifically. You said the expectation is for here a handful of 25 BIP raises in a row, maybe 50 and then taper. What are we looking at likely for February?
Yeah, probably a pair, I would imagine, of 25 basis point rate increases from the Fed, JD, is what we are seeing from the CMA Group Fed Watch. 93 point rate hike. That'll take us to 450. Another one in March takes us to 475. Range of 75.5% is now where the market expects the Fed to top out. The Fed has talked about a Fed funds rate that is north of 5% and will stay there for the year. Bond markets and interest rate markets continue to challenge that consensus. They say they're going to top out at that 475 range, and there is increasing bet cut in the early part of September or perhaps into the last part of the year. Now, I would imagine those bets are predicated on the fact that there could be a recession, but we're now seeing recession bets kind of drift a little. Essentially now, at the prospect, probably 50-50, but actually growth optimism, as measured by Bank of America's Fund Manager Survey, which is a really important monthly indication of where the biggest institutional money is going, is at the highest level that it's been in more than a year. So some of those bets are fading, and as a result, there is the anticipation that if the earnings season can come through, that if inflation can stay on its downward path, then the Fed could actually thread the needle, engineer that soft landing, and avoid recession. And then we have the opportunity for a pickup in the second half of the year, although once again, that will likely change the perspective for Fed rate bets. So there is a lot to play for.
Absolutely. Now, I do want to get to a name that we've already mentioned here, and pardon me from not staring at the camera as I look to see Goldman now trading down 5.8%. I didn't misspeak. That's 5.8%. What's going on here in terms of earnings? For what happened today, it's a tale of two different stories. Morgan Stanley in one direction, Goldman Sachs a different one. What happened with Goldman, Martin?
Yeah, two different stories and two different banking strategies, really, JD. I mean, Goldman Sachs is still an investment bank in the purest form, and of course has an expanding consumer division, which isn't doing well, it has to be said. But Goldman is a bank that is, of course, dependent on trading activity and fees that it gets from mergers and acquisitions and all that other activity. Now, investment banking fees were down about 49% from last year. I think the tally was around 7.36 billion, and that was significantly south of the street expectations. Not terribly surprising because we actually had a really big pullback in M&A activity last year, so the fees are going to decline along with it. The whole SPAC market, of course, which boosted fees in 2021, has fallen off a complete cliff, so they're not getting any boost as far as that's concerned. We haven't seen a great deal of IPOs either. So what we had, JD, was really one of the biggest misses on a quarterly basis for Goldman Sachs earnings in more than 10 years. The street was looking for 548. They only got 332 per share, and they missed on revenues as well, which I think came in at about 10.6 billion. So really not a great deal to pick through and find positives. There was a decent number from the fixed income trading group that beat street forecasts as a result of the bond market volatility that we've experienced over the last 3 months of last year and again into this year, it has to be said. But there were steeper losses in the consumer division, which houses Apple Card. Of course, expenses, which are related to the headcount stories that we've talked about with Goldman Sachs over the past weeks, are rising. They were up 11%, and revenues were down 16%. So there's simply no way to generate a profit in that kind of dynamic. So it explains why Goldman is looking at headcount reductions. And it explains why we're seeing that big decline for the stock today. And as a result, and this is worth remembering, JD, Goldman is, of course, a Dow component. The Dow is a price index. So therefore, it is going to move more sharply on the dollar value change of the stocks that are inside it. And certain stocks have a bigger representation than others. You use something, JD, that's called the Dow divisor. I'm going to speak in the simplest terms, but if you take the number 6.9, multiply it by the dollar change in any particular stock, and you can see the point impact that that stock has on the Dow Jones Industrial Average. So the last I looked, if we're down about 5 or 6%, that's probably going to equate to about 50 or 60 points off of the Dow from Goldman alone. So that's why the Dow is trading sort of out of sync, if you will, with the modest gains that we're seeing for the S&P 500.
And that's a really good perspective because as we've been talking, I've had the list of the Dow 30. It is undeniably the biggest laggard of those Dow 30 names, though Travelers Insurance not very far behind, but for what's otherwise a very strong day for top names, at least like McDonald's, Chevron, Coca-Cola, Apple up about 9/10 or so. You really do have that significant drag down at the bottom of the list. And I'm glad you brought up the Dow divisor for, listen, we can get wonky on the show from time to time. We don't have to be afraid not to be. I'm going to hold the space for you, Martin. When that brilliant brain of yours wants to go down those deep rabbit holes and think, I don't know if the crowd's ready for it, I got you, man. I'm here to ask the questions that people have. Of course. So then let me get your perspective here then on the flip side of the equation, and let's talk Morgan Stanley. It's up about already 7% so far through the first few weeks of the year. It's kind of funny to say year to date when it's only January 17th, but up almost 7 year to date. What do we learn there specifically from Morgan and its strategy? Very different, perhaps, from the aforementioned Goldman.
Yeah, no question about it. Morgan Stanley has made this transition really over the past decade and has been moving more towards a reliance on wealth management as opposed to investment banking in order to generate the bulk of its earnings. Wealth management revenues were up about 6% when compared to last year, so that's a really solid gain. And actually, the Morgan Stanley trading division performed much better than anticipated. I think their revenues were up about 26%. So those were really good metrics for the most important drivers of Morgan Stanley earnings. Investment banking fees were down 48%, but again, that's in line with virtually everyone that we've seen on Wall Street so far today, and the numbers we got on Friday. So you roll that all together and you get a beat on the top and bottom line for Morgan Stanley. I think it came in at 131 per share, beat by about 12 or 13 cents, depending on whose numbers you're looking for. But it does, again, sort of represent the way that certain banking stocks can outperform when their rivals aren't doing as well. Now, Morgan Stanley ultimately is probably going to be put in a silo that's slightly different from its rivals, such as Goldman Sachs and JP Morgan and Citigroup. It's not exactly the same as Wells Fargo. It isn't the same as the other three names that I've mentioned. It's kind of a standalone, but it does sit in that group of six. And as a result, if investors are looking for a way to hedge risk as they go into the earnings season, particularly if they see a decline in investment banking fees and all the other things that have been weighing on stocks like Goldman and JP Morgan, they can look to Morgan Stanley because, again, that wealth management division acts as a bit of a circuit breaker, if you will, to those declines and makes it a little bit more steady and a little bit more predictable.
Yeah, of course, one of the things that the Morgan Stanley chief executive weighed in on today with regards to confidence of overall deal activity, that's M&A or IPO deals, once the Fed pauses, one of many kind of points. If you take a look at the last 2 days here, and I mean by 2 trading days, including Friday, and you look at the big 6 names or so, was there a recurring trend with regards to recession concerns? Because they're more or less aligned. Was there any outlier who seems to be putting out information or suggestions or guidance that's dramatically different from the rest of the big names in the financial space, I wonder?
I think it was Citigroup, but I hesitate to say because I can't remember for sure, which said basically their central case is for a mild recession this year. And I think to some degree that was reflected in the credit provisions that we saw from all 6 of the biggest Wall Street banks. Essentially what they do is they have to set aside a portion of their capital base. It won't be used. It will be used essentially to absorb potential losses. So that's capital that they can't use to expand their business, and at the same time they have to set aside essentially for a rainy day. The composite number was higher than Wall Street had been looking for. In other words, the collective from the 6 banks, I think, was somewhere approaching $7 billion US. The market was looking for somewhere around 5.7 to 6. So that does suggest a bit more caution. It reflects, of course, the nature of each of their businesses. So it's not always like for like, but nonetheless, if you are seeing that big expansion, it's about 50% higher than it was last year. You have to assume that the banks are looking for potential loan defaults, for bad credit cards, for bad mortgages, and all the rest of it. And as a result, they're putting that capital aside. So that was probably the most significant of the recession concerns that we saw from the bank reporting. But it was mentioned on Friday, and I think it's worth echoing, bank earnings, bank stocks trade very erratically in and around earnings because they take so long to pick through that the algorithms don't always pick up precisely what headlines are going to drive stock performance and indeed earnings performance. So it very often is several days after the numbers come out, the analysts have a deeper look, and then the trading commences once again that we understand where these things are going. Wells Fargo is a great example. It traded significantly lower off of the headlines on Friday morning. It rebounded firmly into the end of the session, and there were 3 analyst downgrades again this morning, and the stock is back in the red. So you're going to see that kind of volatile trading for the next 2 or 3 days, I should imagine, and it might not be closer until the end of the week that we understand where these stocks are headed when the analysts are able to dig through the mountain of numbers that are typically associated with bank earnings.
Of course, earnings season is not only the big financial names. If you look ahead to just the next few days, we will hear from names like Procter & Gamble, Netflix as well. I'm curious what other names may be top of mind. Big ones for you to watch that you might want someone watching at home to also keep an eye open for.
Yeah, I think you mentioned the 2 that are likely to be the most important. United Airlines and American Airlines will also report this week, and there's been some mixed data out of the airlines over this reporting season, so I'll be interested to see what their forecasts are going to be and if travel is going to maintain the pace that it has, whether they are looking to expand capacity and what they see in terms of margins. What I think will be interesting is Procter and Gamble's numbers. Obviously, they're operating in a brand space that has been able to increase prices significantly, and customers are able to absorb it as such. I'll be interested to see where they feel price hikes are headed, because that will be to some degree a proxy for consumer price inflation from one of the biggest brand name companies in the world. That will be fascinating to see, and what they were able to achieve in terms of top and bottom line performance. Netflix, of course, is always interesting. I think for the longest time it was seen as the kickoff to the tech sector earnings. I don't necessarily think that people see that in the same light anymore. It's now really a profit and subscriber growth story. Netflix, of course, is also raising prices. It's rolling out that new ad-driven service. There's been some headlines and some suggestions that it's not going as well as first anticipated. But I think this is always worthwhile remembering, and it bears repeating. Netflix always guides cautiously. They always, always, always guide cautiously. So whatever the anticipation is heading into the numbers, you can be sure that's probably not going to be what comes out at the end of the day. So I'm going to look to that with great interest. I want to see what the company has to say with respect to the ad-driven service, how they're growing subscribers, and actually what kind of profitability they're getting from the subscriber base, because that, of course, JD, is going to have an incredible influence on what we're seeing out of Disney right now and the proxy fight between Nelson Peltz and management over there.
Oh, yeah, wait, that's a whole other, hold on, is that in our rundown today? Are we talking the Disney Peltz story or not yet?
Unfortunately, the Disney's pushback came a little bit too late, but I'm willing to give it the old college try if you want to dip in.
Let's hit it in one question. I will get to it in a second. I first want to clarify on Netflix. Essentially, it's a under promise, over deliver. Is kind of how they go about it for the guidance.
Yeah, absolutely. Now the stock is going to trade on Netflix forecasts into the first quarter of this year. It's going to trade very sharply in the after hours as a result of that number. But I would really caution viewers, if you are willing to take the risk and trade around the headline number at the end of the day on Thursday, be reminded that Netflix is very cautious in its guidance, and the number that we get at the end of the day on Thursday may not reflect what the stock does on Friday morning.
Yeah, it has beat on earnings per share. Taking a look here now at the last 4 quarters. It is scheduled for Thursday the 19th. You said after the bell. Right now the stock is trading down 2.2%. We will follow that closely. I know you and I will talk about it on Thursday, and I'm sure again on Friday.
Absolutely.
Okay, we want to hit this this House of Mouse Peltz thing. Okay, so people have undoubtedly seen headlines. Give me your sense to try and get us caught up and why it matters, with a promise that we will give this much more focus later on in the week, and we can build it out a bit. It's a fascinating one, right?
It is a big story. I mean, Nelson Peltz is one of the most recognized activist investors in the world, and he has a great track record of pushing companies into changes that he sees as driving shareholder growth. Now, there's an argument to be made that Disney absolutely needs it. Their stock was trading at an 8-year low just a couple of weeks ago, and it's one of the underperformers on the Dow for the past 2 years. They are trying to expand their direct-to-consumer business, which is the Disney Plus that we all know about. They're raising prices. They're trying to grow subscribers. But the profitability just isn't forthcoming. And as a result, they may not see that sort of in the black until 2024 or perhaps even beyond. And their debt pile is growing at the same time, and their parks business may not be able to match the earnings growth that we've seen in the post-pandemic period. So Nelson Peltz is driving for significant changes. He wants to cut costs. He wants to align management pay with stock performance, and he wants a seat on the board as well. And he also wants to talk about the CEO succession plan now, of course, that Bob Iger is back in the main chair after the ouster of Bob Chapek, who Iger basically stumped for earlier in October. Disney's pushing back, says Peltz doesn't know enough about the business to push for the changes that he's asking for, and he's actually cherry-picking some of the data and offering misinformation on others. So this is going to be an epic battle. The AGM, I think, is in March, and we'll see where it all plays out. But the pressure on Disney is going to intensify if Netflix is able to outperform and they are not.
Yeah, absolutely. You're correct. Disney had issued a statement slamming Nelson Peltz. You gotta love headline writers. When all else fails and they write about a story of contention, they always use the word slam. So and so
Slam.
slams, whatever. Trump
Yeah.
slams CNN, and I say that as a
Yeah.
longtime editor and headline writer, and I would be embarrassed if you had to search through my archives from many years ago of how many times I used the word slams in headlines. Anyway, it's being used today with regards to Disney's response. Thank you for briefly addressing that. We will focus on it much more as the week rolls along. A little bit of a teaser there for the folks at home to dig more into the story. We'll build it out with elements and graphics. It'll look really nice. Okay, what do we want to hit now? Okay, we already did Fed Group here. Oh, we got to talk China here before we get to rapid fire. Overnight data from China showing the weakest full-year economic growth in over 5 decades. Martin, you see it there on your screen. Just how concerning is this?
It's a really fascinating number. I mean, as you say, that 3% growth sort of objective for 2022 was well shy of the government's target of growth of around 5.5%. Now, those numbers are not simply ephemeral. I think there is always concern as to whether or not China is accurately measuring not only all of its economic metrics, but indeed its broader GDP numbers. But if they are willing to say that GDP is that south of the government's forecast, you can imagine, even if you do believe that number, it may actually be even less. This is significant, JD, because it relates to concern that the Chinese Communist Party has talked about for a number of years, quietly in some instances and vocally in others, about the sort of the risk for public unrest as a result of weaker economic growth and rising unemployment. Now, we saw tiny slivers of that as a result of the protests linked to the COVID restrictions, which were quickly abandoned in November. But you simply can't have a country of this size managed effectively if economic growth is slowing and unemployment is rising. There's simply too much political and civil unrest to risk to manage, and as a result, I think this is why these numbers are so significant. Now, fourth quarter GDP was actually stronger than some analysts had expected. We basically got that late December boost as a result of the drop in the COVID restrictions. There was an upbeat look in terms of retail sales. There's obviously some boost in government investment, and the reopening of the economy hopefully will engender the kind of economic growth that will keep sort of employment in line with government objectives, and as a result keep the civil unrest at a minimum. But you can't discount the fact that we are looking at COVID infections that are ripping through what is, at least for the moment, the world's biggest population. The Lunar New Year celebrations are rapidly approaching. There's going to be travel from cities out to the countryside and then back again. And there are some estimates, JD, that say as much as 90% of the population at the extreme could become infected over the next month. We simply don't know what that's going to mean, either from a human perspective or from an economic perspective. So whilst we're seeing, and I referenced that fund manager survey again from Bank of America, we are seeing the most optimistic China growth forecasts in 17 years. I think it still has to be caveated by the fact that we don't know what the conclusion is going to be from basically the careening of COVID restrictions to reopening within a period of just a few months, and having that coincide with Lunar New Year travel and celebrations. That's a huge unknown. And as a result, I think that's why the markets were looking at these numbers with sort of a skeptical eye.
Yeah, it's incredible. And when you talk projections and you listen to interviews with CEOs, where are those opportunities for growth for the future? It's almost a knee-jerk reaction. So many of them say, well, you look to China and you look to either Asian equities or components that are coming out of that part of the world, despite the fact that clearly they are dealing with a lot of short-term headwinds. I wonder what that kind of calculus looks like in more nuance to take those short-term risks versus the potential for long-term growth. It's a really important conversation, and I appreciate the context on there. Anything else on that here before we hit rapid fire?
Well, I think you're right to think about the longer-term implications, because the data that came out today said the population is shrinking. It's actually shrunk for the first time since 1961, 850,000 less than the last time they took the measurement, and it's probably going to be overtaken by India in the next few years as the world's most populous country. Now, this raises a big question that analysts and economists have been grappling with for a number of years, JD. Will China get old before it gets rich? In other words, if we are seeing these big demographic changes, what does that have to say about the economy's ultimate potential and the opportunity that it has to overtake the United States in terms of nominal GDP size? The earlier forecast were that was going to happen in around 2030. I don't think anybody's making that argument anymore. And this demographic shift, whilst really only based on one set of data, is moving absolutely in the wrong direction. And as a result, the chances of the population growing in the next 40 to 50 years are incredibly low. And that has, of course, significant implications for what China's GDP can ultimately achieve. And that, of course, changes everybody's calculus, as you alluded to.
Yeah, that's just what an incredible story of importance to continue to follow, especially because, I mean, it's one of those things that we heard from so many of the big bank CEOs weigh in on here in recent days. We'll continue to hear as earnings reports goes along, and you hear from a lot of these big companies. You will hear them. Oh, that's going to be such a fascinating part of these calls and to listen in on about those concerns out of China, the good, the bad, the short term, the long term, and we'll talk more about that on the show in the future as well. Okay, time now for our rapid fire section. The first one under the show's rebrand here. Number one, GameStop's Ryan Cohen built a stake in Alibaba. Is this a big deal, Martin?
Well, I think there's the anticipation that an activist investor in a Chinese stock, which is incredibly rare, might drive some of that meme stock appetite into the China names that are listed on U.S. exchanges. The reports say that Ryan Cohen has built a multi-million-dollar stake in Alibaba. He's pushing for changes in the world's biggest tech company, Asia's biggest tech company, and he wants them to boost share buybacks and do a couple of other things. I think the chances of him having any influence on this company are relatively small. And of course, Alibaba's fortunes are very much tied to the broader themes that we've been speaking about with respect to the China economy. But nonetheless, this might be a trigger to drive some retail interest into China names. And that would be an interesting dynamic heading into the first few months of the year.
Absolutely. Okay, on to number two we go. It's a big day for Elon Musk. The trial linked to that infamous 2018 tweet, I guess a series of them. I think everyone remembers the 420 funding secured one specifically about taking Tesla private. That begins. San Francisco, what should we expect?
I think ultimately the jury is going to decide what kind of impact, if any, this has had on shareholders of Tesla. I mean, even if we were to look at the 420 level on a split adjusted basis, the stock is still well north of that. Trading right now. So it's a good thing the company wasn't traded public. So long-term investors wouldn't have been harmed at all. But that doesn't say, that doesn't absolve Mr. Musk from making statements that the judge in this case has said were false and reckless, that he did not have funding secured at 420 a share. And he didn't have the deal as certain as he described it to Tesla shareholders through his Twitter account at the time. The SEC has slapped him on the wrist as a result of this. Musk has maintained that his statements were true, even though essentially two authorities have told him that that isn't the case. So we'll eventually have to see what, if anything, will be paid out to investors as a result of the statements. But Musk has faced judges before. The odds have looked against him, and he's been able to escape scot-free. So I think even if there is a result, it's not going to be terribly damaging to the world's second richest man. But again, it's just another indication of maybe his impetuousness, shall we say, when it comes to social media.
Impetuous? No way. Yes.
I know, hard to believe.
Okay, hard to believe. Who would have thought it? Literally everyone who's ever read the man's Twitter account. Okay, third and final, is there real concern over the Activision-Microsoft deal? What's going on there?
It seems to be increasing. We've seen reporting over the weekend that the European Union and the Competition Commission, which has tremendous influence over the tech sector globally and mergers most specifically, has issued a statement of objections, or is going to issue a statement of objections against the deal. Now, they would essentially join the FTC, which is suing to prevent it, and authorities in the UK, which have basically said they're going to take 6 months or perhaps even longer to probe the transaction because they're worried about its effect on a very significant industry, this, of course, being video games. If Microsoft were able to execute the deal, the potential is that they could bring Activision's games, such as Call of Duty, onto their own consoles and keep them off rivals such as Sony. Activision is also going to hit this morning as a result of losing its partnership with a company called NetEase in China, which helps it publish those games into the world's biggest video game market. They had been planning to drop NetEase for a long time, but they were hoping for a bit of a transition period from which they could find another China-based partner. But NetEase essentially said, nope, we're leaving right now. And that means Activision won't be able to sell into China, at least in the near term, and some of its new releases might be delayed as a result. So twin presses on the shares. But I think that deal, which was announced this time last year at a tag of about $69 billion, is looking more and more circumspect with each and every headline.
All right, the great Martin Baccardax. Martin, it's the first time we've done this here at our new time, new show, new phone, who dis? You good vibes? How we feeling?
It's good fun. Fantastic graphics from the team. I mean, hats off. It's really starting to look good, and it gives us a bit of extra time to absorb the market open, and as a result, give you guys hopefully a little bit better information. So I'm enjoying it.
Yeah, absolutely. Me too. Yeah, shout out to the team. Whole new graphics package. Really animates things as we go along. Great. And my special thanks to all of them. And my special thanks to you, Martin, as always. And of course, my special thanks to everyone watching at home. Martin, we'll do it again tomorrow. See you then, man.
Sounds good. Thanks, JD.
You got it. Oh, Martin and I did not even break down the weekend of NFL football just yet. Don't worry. Lots of days ahead to talk about it. That's going to do it for The Street here today. Stick with The Street for more. Oh, that's going to do it for The Street today. Right, there we go. I'm fine with the teleprompter. Stick with The Street for more on these and all of the major market stories that matter to you, and we will see you tomorrow.